Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for September 24, episode 309. We're coming to you live. I'm Dean Croak, market analyst here at DAT, along with co-host Chad Kennedy, who's in the path of the hurricane coming through the Gulf this week, and special guest, very timely to have international shipping expert John McCown on the call today. Good morning, guys.
Good morning.
Morning. John, great to have you on this week. Couldn't have timed it better with the potential ILA strike coming up literally in 7 days.
Very pleased to be here. Always enjoy talking about freight, and you're right. The ILA contract ends in a week, and it looks like all signs point to a strike or some sort of labor action.
Yeah, we've got a lot to talk about, a lot of questions we want to ask you about that. So, Chad, how's things looking down your way with, is it Helene coming through?
Yep, that's right. They're not looking too good. It's forecasted right now at a Cat 3 making landfall around Thursday, around that Big Bend area. The cone is kind of stretching from Pensacola down to Tampa area, but it's still a bit too early to tell, so we're just watching it closely.
Right. John, for those that haven't seen you on the show before, can you give us a quick bio and then we'll get into the market update?
Please do. I've really been in the container shipping space for about 4 decades. Most of that was on the operating side. I worked for some 20 years with Malcolm McLean, the gentleman who invented container shipping. I was CEO of a U.S. flag container shipping company moving freight to Puerto Rico in 53-foot boxes for some time. And then after that, I invested in transports worldwide with a large hedge fund. For the past 5 years or so, I've been doing things, writing about transport topics that I enjoy. I put out some reports. I'm a senior fellow for the Center for Maritime Strategy, which is the Navy League's think tank. And there I mostly write about kind of the intersection between commercial shipping and sea lift and national security. So like I say, most of my time is spent, in the container shipping space.
Fantastic. All right. Well, we'll bring John back in a little bit later. I'll get into the market update. We'll get the market update piece out of the way quickly. Don't forget, we're live today, folks. Get your questions into the chat section. We'll get to those as quick as we can. Some of the key trends that we're watching this week, spot rates were for dry bed and flatbed, mostly flat. Reefer slid back another couple of pennies, soft market. Very soft. There's a lull in spot rates in this lead up to peak shipping season, so nothing unusual there. There's a little bit of a rate inflection up towards Columbus Day, and then some inflection around Halloween. We'll talk about that a little bit later. Jason Miller's truckload ton mile index up slightly in June, but down about 0.3% year over year. It's the smallest year over year gain. Jason contends that the Fed interest rate cuts should see trucking demand improve. Those interest rates, of course, interest rate cuts are needed to jumpstart demand for capital investment, particularly in machinery, construction, and motor vehicles, which feed into truckload volume. Cash shipment index came out. Tim Denoyer's report last week, up 1% month over month, but down slightly compared to this time last year. So those two data points suggest that there is some inflection in truckload demand coming off the bottom of this trough that we've been in. Obviously, the big news last week was interest rates cuts were the first time. I think they had 11 increases in 16 months, and then no change for about a year. So last week's 50 basis point cut was fairly aggressive. It was unanimous vote. So that's really good news for carriers. On the port front, of course, and it's timely we've got John on, port officials in New York and New Jersey told CNBC last week they're preparing for a complete work stoppage by the International Longshoremen's Association. That could start next week I think it's scheduled to start next Tuesday, October the 1st. Extensive delays will occur there if that goes on as an extended period strike. This week's market update that'll be published this evening at dat.com/market update. Interesting read. We're talking about the history of DAT, or what was known as dial-a-truck 45 years ago. And we're also talking about some of the history there, how the company started, this fascinating thing called pump jockeys, if you're interested in the history of trucking. We're also having a look at the CAS report. Pairs are starting to move out of Washington State, and the latest slump in farm machinery and how that's going to impact flatbed carriers. So that'll be published this evening at dat.com/market update. All right, let's have a look at our load to truck ratio in dry van. Load post volumes followed seasonal trends last week. They're down about 7% in the last month in the lead up to peak shipping ahead of retail shopping season. Again, this is fairly normal for this time of the year. Equipment posts have been mostly flat for the last month. Load to truck ratio remained mostly unchanged at 3.19. In refrigerated, load post volumes are about 35% lower than the long-term average for week 37, going back to about 2016. Of course, that's being weighed down by lower USDA national produce volumes during this summer to fall produce season transition. We normally see a drop in volume in this transitional period. Equipment posts down last week, load to truck ratio down about 7% to 4.51, almost identical to this time last year. In flatbed, the volume of load posts lost some ground last week. Volumes are just 3% lower than last year. Equipment posts down 8% last week, so the load to truck ratio was up to 12.11. Having a look at our year-over-year look at spot rates, last week dry van line haul rates were below the 3-month trailing average by 3 cents a mile, although there was very little change in the national average last week, mostly flat at $1.61. They're about 3 cents a mile higher than last year and about 4 cents a mile higher than 2019, as you can see on the chart in light green. On our top 50 lanes, based on the volume of loads moved, rates were flat at $1.96 a mile. That's 35 cents a mile higher than the national average for dry van. In the refrigerated market, after remaining around the $2 mark for the last 10 weeks, line haul rates slid back last week. They dropped 2 cents a mile to a national average of $1.97. At $1.97, reefer spot rates are about 2 cents a mile lower than the 3-month trailing average. And in flatbed, flatbed rates remained flat last week, literally averaging $1.97. It's close to the average for the last 6 weeks, so not a lot of change in that market. They're about 9 cents a mile higher than last year, 11 cents a mile higher than in 2019, and about 3 cents a mile lower than the 3-month trailing average. All right, let's have a look at our forecasts now. We'll start off with dry van. Remember, these are our new forecasts. We've got a new format for the short-term forecasting model using our flagship RateCast product in green, which is predicting what rate view will be 35 days out. It more heavily weights longer-term seasonal trends. On the chart, you can see an upper error band and a in orange, and a more pessimistic lower band in red. The blue line, of course, is the rolling 7-day weighted average of historical rates for loads moved over 550 miles, excluding fuel. So that's line haul only. All right, in dry van, you can see that RateCast is essentially saying that by the time we get to just before Halloween, rates are going to be flat, although they do go up slightly around Columbus Day and then start to drop back. The high error band has got rates up 4 cents a mile. The low has got them down 5 cents a mile. But remember, RateCast is running at about 96% accuracy. So I think flat right up until Halloween is the most likely scenario. In refrigerated, though, a little bit more pessimistic, the RateCast is looking for a 4 cent per mile drop. Again, this is not unusual for this time of the year. We really don't see refrigerated rates start to inflect until about 3 to 4 weeks out from Thanksgiving. So we're getting towards the period in the rate forecast where rates will drop, and then they'll start to come back up once we get into the latter part of October. On the high side, the error bands are looking for about a 1 cent per mile lift. The lower side's got a fairly aggressive 9 cent per mile drop. But again, RateCast is looking for about a 4 cent per mile drop before we see this seasonal inflection in refrigerated rates heading into fall produce, Thanksgiving, and of course winter. And in flatbed, RateCast is predicting a 5 cent per mile drop. Again, this is in line with what we typically see absent any massive event like a port strike that we'll talk about with John, or hurricanes. We normally see rates dip like this. RateCast is looking for a 5 cent per mile drop out to 10.26. On the high side, it thinks rates will still drop 0.2 or 0.2 cents per mile. On the low side, more aggressive at about 8 cents per mile decrease. So that's it for the forecast. Chad, over to you for what you're seeing in the contract side of the market.
Yep. Thanks, Dean. So everything Dean has covered is a broker to carrier perspective from our load board and contribution data. And so what I'll cover here is contract and spot data from our shippers' perspective. The first metric here in yellow is the spot premium ratio. This is the premium for spot rates compared to contract rates going back to 2017. You can see that we're currently at negative 9.8%, which is still depressed rates. So spot rates are 9.8% below contract rates. Now onto the new rate differential here in blue. New rate differential is the percentage difference between new contract rates entering routing guides and those that they have replaced. Currently at negative 1.3% for dry van, but you can see it's been bouncing around there close to zero. As this starts to go up above zero, that's a clear signal that the market has started to turn. So we're getting close. This is starting to look kind of like maybe equilibrium territory. And then on to the contract rate index. This is a measure relative to 2016 index. So we're currently at 16.4%, but really the takeaway here is that it's very flat over the last several months. So again, looking like equilibrium type territory. And then on to reefer, spot premium ratio at negative 11%, still depressed rates. And then the new rate differential ticking up the last 2 weeks above 0%. So shippers taking some rate increases on contract rates, but very, very small. Contract rate index is still flat to ticking down slightly. And then on to flatbed, that spot premium ratio, highly volatile as we would expect from flatbed, still negative 8.3%. And that new rate differential still hanging down there in the negatives, hasn't come up to zero yet. So still at negative 6.7%. And that contract rate index still pretty flat. So similar story across the board. And then extra bonus this week, I plugged in the intermodal data here. So that new rate differential, we don't cover spot on intermodal, very small percentage of shippers data, less than 1%. But it is at negative 9%. And you do see that it had ticked up over 0% there earlier this year, late last year. Those contract rate index, slight ticks up, but still pretty flat. What we normally see is intermodal rates lag dry van rates pretty significantly. So that's a wrap on contract rates for shippers.
Still have pricing power, and for how long though, Chad? What's your crystal ball saying?
Yeah, we'll see. Maybe Q1, Q2. It'll be interesting to see.
Yeah,
I would probably lean closer to Q2.
Yeah, I was with some shippers and carriers last week on the large shipper TL side, and it was interesting back and forward. They were talking about rates being unsustainable where they are, and of course the shippers are looking for longer bids to try and lock in lower rates, and carriers are trying to hedge their bets and pick where rates will be to keep the volume right now. So it's a tricky period for a lot of carriers and shippers, I guess.
It is. I've heard that strategy from shippers. I don't think it's widespread, but I have heard some shippers try to stretch out 2-year, maybe 3-year contract commitments. But I think that they recognize there's some routing guide leakage risk in the long run on those contract rates once the market starts to turn.
Yeah, acceptance rates are still up in that 95 to 96% range. So there's not a lot of routing guide failure going on at the moment on the
That's right.
side.
Yeah.
All right, let's get to the fun part of the show. Let's bring John back in. John, question of the week. The big question, of course, on everyone's mind is, in the event a threatened ILA strike occurs next week, what do you think the disruption is going to look like?
Well, the short answer is it's going to be a mess, a very big mess. First, as background, the container shipping market in terms of inbound volume has just been ripping throughout this year. The numbers for August, kind of year over year, we had 19% more inbound containers, and year to date, it's almost kind of the same level. So there's been extraordinary strength, and there've been a lot of folks that have suggested that it's some front-end loading out of concern of the strike, and even some potential concern of tariffs. I don't see that in the data. What there has been some coastal shifting, and so that 19% in August is kind of comprised of 28% growth in West Coast and only 10% in East Coast. So that is clearly some shippers, hedging their bets, if you will, and bringing it in over the West Coast. And of course, if you're talking freight that is destined for the Eastern U.S. or even the middle part, you can still move it, obviously, intermodal. But to get back to what would happen, it's looking first increasingly likely that there will be some sort of action. And ILA covers all of the ports from Maine to Texas. And so there's really no place that you can go. To put the numbers into perspective, this would be much worse than an ILWU, which is the West Coast strike, both in terms of volume and kind of the consistency of that volume, kind of where it comes from. The simple numbers are, if you take all of the loads moving over those ports in and out, you're looking at 60,000 TEUs per day, or 300 well over 300 or 400,000 TEUs a week. And the value of those, quickly gets into the billions. I think it's close to $3 billion a day of commerce. If there's a coast-wide strike, with all of the coasts shutting down, there's not a lot of easy alternatives. And so you'll have ships just waiting at anchor. There'll be some attempt to kind of reroute, but again, there's not the easy alternatives. You had, when you had a West Coast potential strike, an easier alternative was to route that to the East Coast. In fact, ironically, for a lot of that freight, it benefited you cost-wise. Typically, you just didn't get the speed. And so, also the West Coast was a bit more, certainly they move freight from all places, but a bit more focused on the Asia line. When you're looking at the East Coast and Gulf Coast, it's not only more volume, but it's volume coming from everywhere. Obviously some Asia, but you have a giant transatlantic lane. You have lanes going to the Middle East, South America, and those simply don't lend themselves to the same, people that, you're not going to have somebody typically moving a transatlantic load going to the population centers on the East Coast. It says, well, I'm going to route that through the Panama Canal and put it over the West Coast, because rather than being less cost is the alternative, when West Coast loads are shifted to East Coast ports, that's more cost. So it's just going to be a potentially a real mess and jam things up. Now, that's kind of the worst case, and because would have such a pronounced effect, my own view is that it's not likely. It's almost too powerful of a weapon by the ILA, because it literally almost forces President Biden to invoke the Taft-Hartley Act. That doesn't mean that something isn't going to happen, though. And so my expectation is you're going to see more select actions at ports and terminals, enough to be quite disruptive. And really anything will be disruptive, but not enough to invoke Taft-Hartley. So, I know I'm using a lot of adjectives to talk about this, but if it goes on, and if hypothetically you had a wider disruption across ports, it'll be the lead news every day, and it will quickly and immediately start to have ripple effects, and as big as the dollars involved in the commerce that it would stop, the knock-on effects are even worse. And I was asked by one reporter, well, what industries what would it affect? And my flippant answer was everything. But there are industries that you can kind of see the most immediate effect. And the two that kind of come to mind to me are automobiles. We now have more automobiles sold in the U.S. that are assembled here. And most of those are assembled from the container shipping business does a giant business in moving, engine blocks and large sub-assemblies of cars that are finally assembled here. And that's going to immediately be affected. Also agriculture really on both directions, both import and export. The other thing about the East Coast ports that is different than the West Coast is they have much more export business relative to their import. On the East Coast, you're looking at kind of 2-to-1 inbound loads to outbound. West Coast is 3.5 to 1. So obviously the export is going to be affected, and that relates most directly to jobs. So you can kind of really start to see the ripple effects, as being quite significant.
John, what is the?
Sorry,
Dean. John, I was going to ask about the scenarios of different time ranges that this could extend. I would expect there's a one-day scenario where the government intervenes quickly, but how long could this go out based on history?
Well, from the news, I guess there are reports that the president would not invoke, is not thinking of invoking Taft-Hartley prior to stop any action. We don't have a lot of precedents. You have to go back to 2002 when there was an actual strike, and that was on the West Coast with the ILWU, and it ended up being, I think, 10 days, and it was really a bit more of a work stoppage, but that was, again, lead news every day. And I recall that was one that President Bush did invoke Taft-Hartley. Historically, the ILA has not been, if you kind of compare the two unions, very similar, but the ILA has generally been the one that has not striked, that has reached agreements. In the case of, with the ILWU being more militant. Now there's some key issues that both sides are kind of digging in, and particularly on the ILA side, they have repeatedly expressed concern over automation, and in some cases even things that the industry kind of thought were already agreeable, and so both sides are really kind of drawing a line in the sand. The interesting dynamic here, and it's perhaps only interesting to me, but usually in a strike, both sides are experiencing economic pain. The pain from the union of people not working, and the pain from the company of not getting their product out. This is a situation where it will most likely see some pretty significant increase in rates. So you find yourself wondering, clearly the container shipping industry will have massive cost that will be, in my view, more than mitigated by pricing action. So one wonders if that's a dynamic that is just unusual in this situation.
John, I was doing some data analytics on Sunday, and because some media calls were coming in asking about the impact on the container side of the business, and I quickly realized, to your point, that about when you just look at break bulk tonnage and including roll-on, roll-off tonnage, about 75% of that nationally comes into the eastern Gulf coasts. In fact, when you look at all of our top 10 ports for break bulk ro-ro, they're all on the eastern Gulf Coast. And what jumped out at me was that when you look at the pure tonnage, automobiles account for about 70%. You've got some construction and trucks and tractors in there making up the balance. But 91% of that ro-ro break bulk tonnage comes from Europe and 80% from Germany. So when you look at the import side of it, this becomes, I think, more of an automobile industry issue from a supply chain perspective, disruption. That's certainly how you see it, but do you see any sort of redundancy in supply chains that might mitigate this if this strike went on a lengthy period, given that the ocean carriers don't have other diversionary options?
Well, again, it doesn't lend itself to many easy alternatives. I think the one thing that if it goes on for any period of time, and even now, there are probably people looking at can we route inbound cargo via Mexico or via Canada, because at least if we get it in there, we can move it overland. As in the maritime field, these supply chains, aren't really designed to kind of turn on a dime. It takes these companies a long time to put something in place, and that kind of brings up what's unfortunate kind of long-term effect. These sort of things, and obviously it will end at some point, but in boardrooms across the country, there are people that will take this into account, when they're designing supply chains. And sadly, I think that would probably negatively impact, some of the ports that were impacted. You could even see some people saying, well, let's design our system where we have more freight coming in through Canada or more freight coming in through Mexico, particularly if it's being routed intermodally. There's a port in Canada, Prince Rupert, which almost all of the cargo coming into Prince Rupert, because it's particularly close to Asia, moves cross country on double stack cranes to New York. And so that's an alternative. But you make a great point about it's not just containers. It's really the ILA kind of handles everything. Now the labor is focused on containers, but bulk shipments and all sorts of things that kind of quickly back up. And the other thing is that think of container shipping as a system, where there's a constant handoff, and it normally works pretty well. But when any part of it gets jammed up, you get into so many kind of knock-on effects. And this will not only be a U.S. problem, it'll quickly become a global problem, because those ports on the East and Gulf Coast, by my calculation, tie into 16% of worldwide container miles. In other words, 1/6. And so to the extent that those ships are at anchor, and even the ones, there'll be some rerouting, but the ports that are available will quickly get jammed up. So you almost have the same problem. And I throw out that 16% because that's twice as much as the capacity impact of the Red Sea situation. And the Red Sea situation is what has put freight rates on kind of afterburners. And so you have that real potential, not only potential, but likelihood coming into effect here.
John or Dean, I'm curious about the downstream supply chain for the break bulk shipments coming inbound and the roll-on, roll-off, which I think is mostly automobiles or heavy equipment on wheels, right? What does that supply chain look like? And so what are those downstream effects that would occur? Are these movements going into warehouses that are close by to the ports and then cross-dock from there, or are they going straight into the DCs and plants?
On the roadside, Chad, they're going straight to the assembly plants, whether they be tractor, farm machinery, implements, in and around Baltimore, for example. As we saw when the Key Bridge fell, there was a lot of movement to Norfolk, for example, rerouting there. Some of it goes out to the Midwest. I've got a number of friends that it's almost live load, so they're live loading machines as they come off the ship, whether it be rubber tide dozers, telehandlers, expensive drilling equipment. A lot of it goes straight onto a drop deck or a specialized trailer and gets trucked straight to market. So there'll be an immediate impact there, I'm sure. I'm already seeing, just anecdotally through some friends of mine that run extendable drop decks, they're seeing some volume come into Halifax already that they're moving into the US, which is kind of counterintuitive. But there is some of that already happening. Some of those ports that John mentioned are equipped to handle roll-on, roll-off freight. So I expect some impact there. The mitigating fact, Chad, is that we're not in peak season. So March is typically peak machinery, construction, planting seasons when we see those sorts of volumes pick up substantially. So we're in the low point when you look at pure tonnage on the road side for trucks, that is.
John, from a shipper's perspective on the export side, you start to look at options at this point. You're 7 days out. I would think that you're starting to look at options. Should I start to rail to the West Coast and export from there, I would assume?
Well, I think at this point, in many cases, it's a little bit too late to look at options because, with the container, it often starts to kind of move. It's in the container, and your options might be moving some other mode. So I think that at least initially, people are just gonna kind of be where they are and kind of hope that this quickly resolves itself.
Wait it out.
It's worth noting also that in the U.S. there are over 35 ports that have regular container service. I kind of focus on the top 10 ports, and those are the big ones. They collectively are about 86% of the cargo. But if you look at all of those small ports, 24 or so, almost all of those are in the eastern Gulf Coast, and some of them are pretty good-sized ports. As Dean mentioned, Baltimore is right outside of the top 10. Has a giant niche in terms of ro-ro, and you can kind of go down port by port, the specialty that they are involved in, and that aspect is really just kind of shut down by this. I mean, I think of a little port like Gulfport, which is particularly known for chicken, and so you have the impact of this. It's not really just on the big ports. It's really going to kind of be spread. I dare say almost every state along the Gulf Coast or East Coast would see some impact, on this.
Yeah, very interesting stuff. I think, John, you touched on something that we saw during the West Coast strike, and that wasn't a full-out work stoppage, but we had some cranes get locked out, red tagged, which essentially shut down the Port of Oakland for an entire day. So we could, and probably most likely will see impact at a shift level. And to your point, Chad, that will really impact truckload carriers, because that'll cause the equivalent of vessel bunching, where you've got trucks backed up in markets and delays trying to get freight moved, and that'll have a definite impact on rates. Mm-hmm. All right, John, this has gone way too fast. A very interesting discussion. I've learned some new data points today that I hadn't really thought about. John, before we sort of wrap up the show with some shout outs, how can people get in contact with you to learn more and subscribe to your monthly report?
They can send me an email. My email is john.d.mccown, MCCOWN@gmail.com. And I'd be pleased to add them to my distribution list.
Yeah, it's a great read. Thank you very much. It's focused on the top 10. Shoot John an email and subscribe to that email. Comes out every month. All right, so on Freightline Podcast, Professor Kaplis is talking to Philippe Capella, CEO of LoadSmart, talking about AI in transportation. That's out right now. Don't forget, DATCon is coming up in Kansas City, October 2022 to 24. You can go to dat.com/DATCon to sign up. Make sure you subscribe to our channel, set up alerts so you can get a notification of today's show. And with that, another show is in the books. Be safe, be nice to everyone, and we'll see you here again next week at 10 a.m. Eastern, 7 a.m. Pacific.